The Federal Reserve will be holding its September meeting this week. According to the CME FedWatch tool, markets are assigning a 96% probability of a 25 basis point cut, with a small chance of a larger 50 basis point cut. But the real question isn't about whether the Fed will cut rates or not. Will lower rates cause the market to rally all the way to 7,000? And what are the sectors that might benefit from the rate cuts? Let's find out in this video. So the reason everyone is expecting the Fed to cut rates now is because cracks are starting to show in the labour markets. In August, non-farm payrolls rose by just 22,000. This is far below the 75,000 economists had forecast. Even worse, June's number was revised down to show a net loss of 13,000 jobs. This is the first negative print in nearly 5 years, going back all the way to the pandemic. Now, even though July and August came in positive, many analysts are expecting those figures to be revised downward as well. On top of that, the unemployment rate climbed to 4.3%. This again was the highest since 2020. And for the first time since April 2021, the number of unemployed Americans now actually exceeds the number of job openings. When you put all this together, the picture is clear. The labour market is losing momentum. And if this trend continues, more job losses, fewer openings, higher unemployment rates, it could very well tip the US economy into a recession. That's why the Fed is being forced to act now. After holding rates steady for nearly a year, they are now moving towards rate cuts in an effort to reverse the slowdown. So, what would typically happen to the markets after a rate cut? As the wealth of common sense pointed out, the answer depends very much on the type of cut. Is it an emergency cut into recession like during the 2007 global financial crisis, or is it more of a cooling inflation insurance style cut like in 1995? Looking at all the rate cuts since 1970, whenever the cut was followed by a recession, the S&P 500 ended positive a year later only about 64% of the time. On the other hand, when the cut happened in a non-recessionary environment, the odds of the S&P 500 finishing positive jumped to around 86%. So what kind of rate cut is the Fed doing now? Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. While the labour market is slowing, the good news is that the GDP growth rate is still pretty healthy at 3.3%. Consumer spending remains resilient, the services PMI is still above 50, which signals expansion, and household debt service ratios remain close to long-term averages, suggesting that consumers aren't overstretched either. This suggests that at least for now, we are not slipping into a recession. Touch wood lah. That's why this looks more like an insurance card to keep momentum going rather than an emergency move. And if that's the case, history suggests the odds favour the markets moving higher over the next year. Though, of course, none of this matters over the long term, because over a 5-year horizon, whether the Fed cut rates because of a recession or simply to cool the economy, the S&P 500 has always ended up higher 100% of the time. Also, what makes this cut especially unique is that it's happening with markets nearing all-time highs. Historically, whenever the Fed has cut in this environment, the S&P 500 has ended 1 year later positive 100% of the time, with an average return of 13.9%. However, that doesn't mean that it's a straight line up either. Over a 1-month horizon, the odds are basically a 50-50 coin flip, so the markets could either go up or go down over the short term. As to which direction it will be, technicals are now flashing warning signs. The RSI indicator shows that the S&P 500 is nearing overbought levels, which means we could see a pullback, especially if traders do the classic buy the rumor, sell the news. And then there's the calendar effect. September has historically been the weakest month for US equities, with the S&P 500 delivering average negative returns going all the way back to 1950. As to why that happens, it may be due to fund managers locking in gains from earlier in the year, or investors rebalancing portfolios ahead of Q4, which can create selling pressure. Additionally, we will also have a triple witching this month, which sounds scary, but it's just when stock options, index options, and futures all expire simultaneously. Whenever that happens, volatility tends to increase. Historically, if the triple witching happens in September, the S&P 500 has ended the following week higher only 28% of the time, with an average loss of about -1%. So what this all means essentially is that over the short term, you could expect the market to get a little bumpy or even drop. But over the longer term, the odds still remain firmly in the bull's favor. Even Wall Street analysts seem to agree with this view. As of mid-August 2025, the median price target for the S&P 500 by the end of this year is around 6,500 versus the 6,607 level which the S&P 500 is at now. Essentially, what they are saying is that they are expecting the S&P 500 to hold at current levels at least until the year end. And that brings us to the bigger question. Are we in a bubble right now? If we look at valuations, market levels have reached historical extremes, with the S&P 500 trading at some of its highest valuation multiples ever. Likewise, there have been a growing gap between the 12-month forward earnings per share and the actual change in price. In other words, earnings have not kept up with the pace of price increases. This suggests that valuations have already run ahead of fundamentals. However, as the saying goes, the markets can remain irrational longer than you can stay solvent. And just because the market is expensive now doesn't mean that it will crash. So for now, here are a few reasons as to why the market can continue to stay higher for a while longer. First, we may be in the midst of the biggest tech revolution in 20 years, driven by artificial intelligence, cloud computing, and automation. And just like past industrial shifts, investors are willing to price in future growth right now. Second, the US dollar has weakened a lot this year. A weaker dollar is typically good for the S&P 500. Here, you can see that there's a negative correlation between the S&P 500 earnings per share growth and the US dollar index. That's because when the dollar falls, exports become more competitive and foreign earnings translate into higher dollar profits. Third, there's optimism around tariff and trade negotiations with China, which has kept investor sentiment positive. Last but not least, central banks outside the US are also signaling rate cuts, whether it's in Europe, Canada, or South Korea. With central banks around the world starting to ease their monetary policy, that tends to push asset prices higher. Still, despite these tailwinds, there are key risks ahead that could quickly test these valuations. The most immediate one is the Fed's dot plot at this week's meeting. Markets are currently pricing in 3 cuts for the rest of the year. If the dot plot points to fewer cuts, that will disappoint investors and likely trigger a pullback. The second risk is, of course, tariff developments. If talks with China break down, tariffs could come back into play and weigh heavily on corporate earnings. It will be like, ah shit, here we go again kind of moment. And as usual, geopolitical tensions remain a wild card, where energy shocks, conflicts, or supply chain disruptions could easily spark another short-term volatility in the S&P 500. So what assets will typically do well or don't do well after the rate cut? One of the most obvious sectors that will do well is, of course, growth stocks, as lower interest rates benefit them by reducing their borrowing costs. This is also true for rate-sensitive sectors that benefit from rate cuts, such as REITs. In fact, REITs have already begun to run out in expectation of rate cuts. But what about banks? Historically, banks won't do well in a rate cut environment, at least initially. But given that Singapore banks have started to diversify their income sources, I would say that the rate cut may not have that big of an impact on their earnings. Besides that, treasuries will also do well too, since lower yield translates to higher bond prices. Gold is also expected to do well, not so much because of the rate cut, but because there's rising geopolitical tensions, weaker US dollar, and there's a lot of demand for gold right now, whether it's from central banks or retail investors. In short, the Fed is about to cut rates and the market already expects it. In the short term, seasonality, profit-taking, and technicals may cause turbulence. But over the long run, history suggests that the odds still lean in the favor of the bulls. The bigger risk isn't the cut itself, it is whether the Fed can deliver the path of cuts investors expect while navigating trade tensions, inflation, and geopolitics. If they succeed, then maybe Tom Lee's 7,000 S&P's target won't look so crazy after all. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.